What's up, everyone? Yesterday, I was getting ready to listen to the most recent Operators episode. And as I started getting into it, I felt like it would be a perfect opportunity to do a TaylorReacts episode. One, they bring my name up again. So I always use that as an opportunity to stop and give some additional context. But it's right in line with the topic that we've been spending a ton of time on around forecasting and planning. And you'll notice one of the things that we were discussing, we just had yesterday our CFO Summit. If you haven't had a chance to watch my presentation on board, budget, bonus, and scenario planning for 2026. That's now live on our YouTube channel. I would check that out. But the point of it was that in my experience as a CEO right now, this part of the year is not really about Black Friday, Cyber Monday. The reality is that there's a large team that's executing heads down in that. But for me, it's the moment of the year when I actually zoom out and work on 2026 planning. And you're going to see that come out. And I thought it was interesting that on a episode where they start talking about Black Friday just got wild, it very quickly parlays into what is clearly on the top of their mind as CEOs, which is about planning and forecasting. So going to jam through this episode, stop and react to some of the things they say. I think there's some super interesting content here. Hope you enjoy listening with me. If you like these episodes and there's other clips you'd love me to react to, feel free to send them my way, drop them in the comments. But here we go. This is this week's Operators podcast. We'll try and get through it. I'm going 1.5 speed for them. My natural pace is about 1.5 speed. So should be able to get through it pretty quick. We'll fast forward through all those really lengthy reads because I think the actual content is usually about half of the total time. So here we go.
From Built for Shopify, thank you for tuning in to the Operators Podcast. Talk to you later. All right, guys, we're right in the middle of holiday. We have crazy stuff going on. Black Friday sales have started. I just want to kind of get read of the room. I'm hearing very mixed things. As always, e-commerce is a big, diverse industry with a lot of different things going on. But Mike, retail, how's everyone feeling? I hear Target's making a push to win.
Dude, it's a very challenging environment. I think it's going to be a whole.
All right, guys.
Real fast, can we just say that these guys are all so perfectly dressed to character here? You've got Sean in his Mad Happy LA hoodie, right? You've got Mike with the quarter zip, Jason's full sweater with the collar, and Matt's the little bit more casual crew neck. This is just a perfect snapshot of these guys. I love that. So anyways, continuing on.
In the future on e-com, and they got the highest reading ever. And more or less the way they were interpreting that data is that we've been pulling forward Black Friday sales digitally a lot over the last few years by moving up. It's like, it's October 1st, time for Black Friday early sale. And that it seems like consumers this year are just not responding to that messaging as much, that they're waiting more. So we're seeing.
This is a thing that comes up all the time. This idea that we move the shopping behavior is just not true. It's just not true. You may be able to pull forward some of your own revenue depending on how big your business is and how much of the value you create through email and SMS. But otherwise, the concentration remains the same. People shop Black Friday.
Seeing that in physical retail, just like digital, that the consumer is going to be a lot more conscientious about how much they spend. They are waiting for the really big deals, and they're right. There's going to be some really big deals this year. So it's a challenging environment. I would say probably the most challenging environment that, at least from our industry, that we've seen over the 10 years.
What's pushing the deals?
That's a pretty bold claim. He just said it's the worst he's seen in 10 years. That is a pretty good indication of where we're at, right? We've been through some pretty crazy times. I would say that 2022, the back half of it was really worse because of the contrast relative to the previous times. Whereas I think right now we're in a moment that is actually not too dissimilar from last year, really. So it's not great, but I think there's less of the stark contrast coming out of a previous period. There's also no sort of acute issue like we have had historically related to some of the supply chain elements or really just that first year post iOS. So there's been some moments I think that were more acute, but as a general state of the industry, I think he's right to say that this is as low as it gets, or it's been in a decade.
Is it over inventoried? Is it just people need to liquidate for cash? Like what's making it so deal centric?
Yeah, I think some of it is that people are just heavy, and some of it is that people have financial goals that they're trying to hit, and you're not going to get there unless you provide some incentive to the customer to move. For us, because we're privately held, I don't think feel quite the need, but I will say we're being really aggressive on the digital side with deals, and we've got quite a few things happening in physical retail as well. But we've seen other competitors, like Stanley and some of the others, move early and already do some fairly significant discounting. So this is one of the things I think is really interesting about trying to forecast your business, is that it's really difficult to understand how much better things can get in a hurry and how much worse they can get in a hurry. And one of the ways they can get a lot worse in a hurry without you expecting it is that, hey, maybe customer demand drops 10%, but then if all of your competitors start dropping pricing and discounting, then your margins can erode in a hurry. And we're just in a.
So this is actually, I think, it's presented as a dynamic that is hard to understand, but I actually think that that's exactly the kind of cascade of effect that you can begin to see as a pattern match over a lot of repetitions of trying to understand it. So anytime that there's a period of increased demand for a period that deals with then a sudden decrease in demand, what often lags is that because inventory cycles in e-commerce are usually much longer than the rate at which demand can decrease. So in other words, you're placing POs for 6, 9, 12 months ahead. it's almost impossible to not enter a period when demand decreases where you're over inventoried. And when supply and demand, when supply goes way up and demand drops, price goes down with it. That's like sort of macroeconomics 101. And I don't mean that as a belittling to Mike. I think he would agree with the premise. I'm just saying that you should anticipate that in an industry with, especially one with low barrier to entry, the closer to commodity, which drinkware I think would fall into that category, is that when supply exceeds demand, the only way to match those things back into alignment is to lower price, and that happens through discounting.
In a discounting environment, and it's not really clear how severe it's going to get. But I mean, my advice is that people need to be realistic about what are the goals that you need to hit over this season, and if you need to move inventory, you're probably going to have to be pretty aggressive to do it.
Yeah, so let's talk about. We're going to hear from everybody. This is awesome, but like the inputs versus outputs. If you're a public company, your sales target is basically immovable, right? Like you get penalized so hard for missing it, and you report guidance 12 months in advance or whatever, 6 months in advance, right? So if you will do a lot of painful things to make sure you hit forecast. If it's EPS, if it's top line revenue, if it's gross margin, you'll do a lot of painful things.
Just as a fun fact, like when you say painful things, the shenanigans I have seen from publicly traded companies to pull forward revenue realization at the cost of the future, it reminds me it's not too dissimilar from the way that I see professional sports teams that will just cut a player and have their dead money on the cap for years as just an attempt to move past it. But there are some wild things that happen in the name of trying to present the idea that revenue is growing. And there's something about the way that the public markets allow for that I think is a gap.
And this advantage of being a privately held company is you don't have to do that, right? If you're willing to be more movable on revenue targets, you could probably save yourself gross margin or inventory turn or discounting later on, because it's just those are the inputs to get that output. But Matt, so what are you seeing, man?
I guess one thing that stood out with what Mike said is this idea of trying to push consumer earlier, because that's what we're trying to do, right, as brands. Like we're trying to tell the customer, like, hey, we're starting earlier, therefore you should start shopping earlier. I don't know, guys, as long as I've been doing this, we've been trying to move Black Friday up, and it seems that the consumer is moving it back. Like to me, the peak holiday window for the last decade,
it's never moved.
Has just been getting smaller, not bigger. I think we had 2 years in COVID where that maybe there was an anomaly there and there was just demand all the time. But as long as I've been, maybe not 10 years, I've been in almost 20. This has been happening. This is like a common at retail and online. So this is the first year where we're starting our Black Friday offers and messaging today. So we're recording this on Wednesday, November 12th. Last year, we started earlier in November. And we actually, for several years, we started earlier and earlier in November. So we did it too. And when we did all the numbers, basically we just gave up unnecessary margin. There was no like meaningful increase in purchases, like volume or.
I bet that's not too true. In most cases, the discount rate, even in a non-peak season, like if you do it in July, if you discount, you'll get some increase in conversion rate that generally can come close to offsetting the margin profile risk. That's why people get addicted to discounts. It's because it's actually effective in any period of time. So in a second, you're going to hear Sean talk about that. But I don't know that that's a specific anomaly related to November. Anytime you launch a sale, you're going to see some effect where conversion rate goes up, your media efficiency will present higher, but the end marginal result will be pretty much similar. So it tends to be revenue growth, margin neutral, and you can decide like relative to your capacity to sell at full price, whether that's good or not.
Demand. So like sure that you're going to scoop up some people who will start earlier, but I think people just wait. I think we've trained them this way. The whole industry has trained people to wait till Black Friday, and it's all the people who change the damn deal on Black Friday. It's your fault. You're listening, you're one of those people, and you started on November 1st, and on Friday it gets better. You're screwing the rest of us because you're teaching the customer to wait.
Consumers have wised up to, okay, we know that you've got a better deal coming. Like maybe you fooled me a couple of years ago, but I've kind of paid attention and I know like you have like your precursor deal and then the real deal. And I think I'm going to wait for that. I also wonder if, Amazon had some kind of a Prime Day in October that was kind of a flop year over year. But you just wonder if the proliferation of discounting days in October and September and things like that drag down on the ability to start Black Friday early as well.
I don't know. I think from our perspective, Sean, I'm seeing what I need to see to be sort of like cautiously optimistic for both brands. Let's say I'm very optimistic on Pila. I'm cautiously optimistic on Lomi. It is still softer than I thought it would be, given how the first 6 months of the year were. Like we had a really strong first 6 months. Summer was summer. That was pretty on plan for us. It's definitely, I thought it would be better by now. Now I didn't change budget. I actually was pretty.
I don't know why. I guess the question is, what would be the economic driver for improvement? There's almost nothing, right? From the labor market to rates, whatever primary driver, GDP growth is all concentrated into a single sector. Government shutdown. I don't know what would be the driver for positive increase in this moment.
Be pessimistic with plan for us for Q4. Just, not knowing. This year was pretty erratic. I don't know if you guys have been around this year. Lots has changed. So I just figured something else was going to happen. Maybe I'm getting old. But this government shutdown thing has not been awesome for consumer confidence. So,
Well, it's like 12% of the United States population gets their paycheck from the government. So you think that's going to be a drag?
Yeah, it turns out when the government gets really big and starts to employ everybody, that it can happen.
One of the things I think this is a thing that we've adopted. I'm unclear on like how many government workers actually missed payments. This is a thing I've been curious about because this is like a trope that I've heard a lot. Um, Let me rephrase the question. During the recent government shutdown, who actually lost money as a government worker? Um, this totally could be true. It feels off to me. It feels like something that was presented. I saw this as like a suggestion that like the government shutdown was causing this, but it's unclear to me how many people actually like didn't receive money that will not be made up for them. Um, so let's do a quick check on this here for fun. I know some of you are probably going, I know the answer to this, but I'm curious for myself. Like this is a trope that I've heard now presented a lot of different times. Okay, here we go. This is what made sense to me is that short version, almost no federal employees permanently lost their base pay, but a lot of people around the government still got hosed financially. Here's how it works. Legally, they're supposed to get all their wages back. So if you lost money, even their salary for those weeks, the answer is federal employees should get 100% of their missed pay back. So they still miss paychecks for 1 to 2 cycles, which led to late fees, interest on credit cards, overdraft. So wages get restored, but financial damages don't. So yeah, that's fair. And I would guess that in many of those cases, there's probably still some deferrals. Now, federal contractors, employees who work in federal buildings were not covered by the payback law. So there definitely is some. I find it unlikely that there's a high overlap between the contracted government workers who they're referencing in that situation and a strong overlap with our industry in terms of middle to upper class purchasers of D2C businesses. So maybe for these guys, some of them sell at Walmart, Target, etc. But one, I think that trope is something that I think we could dissect a little bit. That I don't totally buy that has too much implication on why D2C performance would be up or down.
Have an impact when those people are laid off.
I was talking to a guy who's in my community group, and he was saying that
and they weren't laid off. So
he works for the government, and he's worked there long enough that he kind of knows the drill, and he has savings and stuff like that. And you kind of just understand that you're going to have crap like this that comes up. But he's like, what really sucks is all the younger people that work for the government, they haven't been through one of these before. And so they weren't prepared at all. There was no savings. There was no ability to take the punch of not getting a paycheck for 5-6 weeks. And so, like you said, and then we didn't even mention this earlier, but like one thing that's changed this year is that the United States started making people pay on their student loans again. And there's tons and tons of student debt. Nobody had been paying on that the last few years. And we restarted that in Q1 this year. So like you said, a lot has changed beneath the hood. And that's one of the reasons why brands are feeling really different performance in the second half of the year versus the first.
Sean, I think another important point you made that stands out to me is around inventory. So I think it's really and you have really long inventory cycles. So like it just takes a long time to get product, and you've made these bets or purchases like 4, 5, 6 months ago. You're in a much worse spot than somebody who's got maybe domestic supply, like they're in consumer packaged goods and things are coming up. Like they can adjust their supply chain. So I think that's where we see bad behavior is like, it's not bad behavior. You see people going deeper.
This is all sort of built around the anti-fragile principle, right? Which is that are you trying to build a business that can resist downtrends, or are you trying to maximize margin capture in a given period of time? A lot of times there's an inverse relationship between resiliency and diversification around things like manufacturing or media and efficiency. So if you think about diversification as sort of wealth maintenance and concentration as wealth creation, like that general heuristic, that applies in things like supply chain, media mixes usually as well, where one is going to be more resistant to issue. It's going to build security, but it's not going to necessarily be the most efficient way to do it. And because e-commerce brands are so margin constrained, they very rarely pursue resilient strategies like that because it's actually not financially possible in the short term.
I'm not calling it bad. That's the wrong use of words. But you see people going deeper earlier. I suspect a lot of it has to do with inventory and just like those kinds of companies, those dynamics.
Yeah, look, and if you brought up CPG, if you're Dude Wipes, you have a very consistent business. You're not seasonal, right? You might not even have seasonal flavor or styles or whatever.
Are you saying pooping isn't seasonal, Sean?
No, as we've established.
But if you're God forbid you're in Christmas tree lights or whatever, it's the most seasonal business ever. You only have last year's comps to go off of. You have no read of the market. You have to just make your bet, and it can work out pretty bad. We'll hear from Jason. I'll give you guys my perspective. But Jason, what are you seeing?
I'm just sitting here waiting my turn. Okay, well, a few things. You said about public companies. And public companies, it's all about beat and raise. Okay, it's a totally different animal. Public company, you need to have a rock solid forecast. You need to beat it, and then you need to raise guidance. And that's the only way you are a successful public company stock, period. If you miss, forget it, toilet. And that's why all of the e-com darlings are all done. On BFCM, we start 2 Fridays before Black Friday every year. That's what we do. It's worked for us. There's no point in starting it sooner, in my opinion. And I have no data to show that we should. And for sure, some people are just showing up in the Cyber 5. Some people are just showing up on Black Friday. That's just what it is, you know? So like this brand starting on the 10th and starting on the 1st, to me, it just sort of...
This is one of those things where it's almost always impossible to prove the counterfactual for any individual business because you can't run 2 simulations of the month of November. But in most cases, I would be willing to bet that the revenue outcome is the same regardless of how you distribute the demand capture.
Signals, desperation. In our world, look, I think the economy is soft. I think the consumer is soft. I see it in our numbers. It's, we're having a really good year. It's very hard for us to know what we should do because of the scale that we're at. And forecasting is just really, really hard when you've had the enormous growth that we have and then have to keep putting it up. And so, my feeling as a private company is I want to maximize profit. And, we're operating the business to
I think there's an important distinction here between saying forecasting is really hard and growing a lot is really hard. I think those are different things that I think get conflated right there, is that I bet their business could be forecasted actually fairly accurately. The question is whether anybody would like that number that it shows. And then if you adjust the forecast to force yourself to drive towards some larger growth expectation, then yes, forecasting becomes difficult. But in reality, what makes it difficult is actually achievement of the proposed or acceptable forecast.
maximize profit. So this year we've taken a fairly steady approach on marketing. And, if we're absolutely crushing, we will raise, we will spend more. But, this year has been the year of keeping spend the same as last year and seeing how we can grow. And we've grown pretty nicely, but have had much better efficiency. So the consumer seems soft to me. I hear it everywhere. I see it everywhere, but people still have to shop for the holidays. That's the beauty, right? So I think the consumer is going to show up. I think everyone out there should be focusing on maximizing profit.
Look, good takes all around. We've taken probably the opposite approach to everybody else on here. Jason, it's interesting you say that you start 2 Fridays before Thanksgiving. You guys should look this up. This is a real thing. I'm not making this up. FDR wanted to raise Thanksgiving earlier in the year. And it's called Franksgiving. It's a real thing. There's a real Wikipedia page article on it because he thought it was too late in the year to spur the economy. So people have been thinking about bringing Black Friday up earlier and earlier since at least the 30s. We started our sale on the 6th. So we were going to start the 15th and we said, hey, let's actually bring the sale up as soon as possible. And it seemed to be a big net positive for our business because what we saw is that conversion rate went up, but CPMs were still lower than they were last year, right? So, once you get to the 15th, everyone's running a sale. You guys run a sale, everybody else is running a sale. So CPMs naturally go up with that. And just by switching to Black Friday messaging, we got this conversion rate boost with lower retention, right? And you could argue that this is a great time to even be filling the funnel for Black Friday, Cyber Monday. So what we've seen is spending less year over year, revenue being up double digits in this weird little early window. So we've really taken advantage of it. I definitely echo that the consumer's in a bad spot, but I've been saying that for 5 years. So are they maybe they're at the worst spot since March of 2020 with COVID, right? But real estate's definitely in a recession. Talk to anybody who works in real estate, no houses are being sold, right? Tech, non-AI tech, definitely in a recession, right? If you're not working on an AI startup, you're definitely in a recession. And then obviously we just had 40 days of 12% of the workforce not being paid. So we'll see how that shapes up to actually end the Christmas season. It could be that there's actually a stronger tail to it, but we've really benefited from starting earlier.
I think the bet, Sean, is that America can't cancel Christmas. It's just, so I think that's still where a lot of my optimism comes from, is I think people will still show up. I just think it's going to be a bit more lumpy, spiky. There's going to be certain places.
There's also this bifurcation that they're talking about in the consumer, right? It's the low end that's really suffering. So it just depends on who's buying your product.
Yeah, man. I mean, maybe for the last episode of the year, we'll do a big postmortem and we'll talk about all the things that happened specifically in 2025, because it has been the hardest year since COVID. I thought every other year was hard for whatever reason, but you don't think about how.
It's interesting. And even the disposition of these guys, you can track their sort of energy and enthusiasm for their own things. And I feel like over the last 4 months, I've watched them struggle in ways that their disposition and their confidence and expression over the previous couple of years, there's just a noticeable difference in their temperament that you can definitely tell that it's they're grinding out this year in a way that I think a ton of people are. So you can go listen to a year and a half ago when they would all interact and talk with each other, and now, and you can definitely feel what they're saying. So Mike said the worst consumer in a decade. Sean's talking about the hardest since March of 2020. Those are bold claims relative to the present state.
How hard things can get. It's also just wild, right? All the tariffs up crazy, Section 221 going away with crazy. There's a lot of net negatives there, but also Temu's dead. So it's probably good. CPMs are down because we were just removed the cheapest advertiser from the market, right? The cheapest retailer. But that also probably doesn't help with inflation data or whatever else. So
Jason, how on the topic of the consumer, how are you guys thinking about forecasting 2026? I mean, this is always a difficult thing. You don't go through holiday
Okay, so here's the fun part. This is actually why I wanted to. This is about where I stopped because these guys are about to go into a topic that I care a lot about that we spend a ton of time and energy on. So excited to really focus on this back half here.
Yet, so you're not through your peak season, and we still have to like sort of get a read of the tea leaves for the next calendar, right? And then you throw in all the variability and macro stuff right now. Like how I'm curious, how are you overly bullish? Are you overly pessimistic? Like bearish? Like where are you landing on the spectrum?
We kind of feel like there's a baseline of growth that we're just going to have based on the value of our brand and the value proposition of our product, and everything that we do, all the seeds that we've been planting for years and years and years. So there's that, we budget off that baseline, and then what are the things that are going to drive growth, right? There's only really two additional levers beyond brand awareness, and it's geographic expansion and new products, and those are two areas that we've spent a ton of time, and we're hoping that we get a lot of traction in 2026 from that, and we will budget like scenarios with and without it, and be willing to make adjustments.
So there you go. There's the first mention of scenario planning. So this is a common theme you're going to hear about different expectations into versions of the forecast that exist.
It's on the fly.
Mike, how are you feeling?
Yeah, for us, our business is kind of bifurcated into a fairly predictable business with our kids. Kind of the idea that you expressed, Matt, of Christmas is going to happen. People are going to show up. We don't know exactly how much they'll buy or how much contribution profit will be there, but they're going to show up. Kids is very similar that, hey, back to school is going to happen every single year. Kids are going to need new water bottles. They're going to need new backpacks. And we really have become, I think, the leader in that space. And so that business has been a lot easier to forecast, and we have exceptional product market fit. And then adult drinkware has been just like a total boomer bust, like impossible, defies all attempts to.
So I want you to remember the statement. So he says it's impossible and defies all attempts. But later, you're going to hear Mike mention that his primary person that he works with admitted to being aggressive and greedy. And this is where I think it's really challenging to, when you miss, to take a step back and ask sort of what occurred, right? And to recognize that at some point when you grow repeatedly, what I see happen is that if you come off of, let's say 50, 100, 120, and all of a sudden you go to do the data work and the data starts to tell you that, ooh, there's actually a signal here that this is only going to be 15%. Part of the reason why you want a third party to support you in this activity is that it is almost impossible for someone in that position to just accept that narrative and bring back to you a depressed story after years of it being different. You're going to be subject to going, no, that's not us. Even this comment that Jason made, there's just a baseline of growth that exists. Those ideas that exist inside of organizations, they become sort of rules that it's very hard for especially a lower level employee to violate that and bring you back information that's different.
For us to project it. And so that's kind of infuriating, but we're learning, as Jason said, I think it's a skill to figure out how to forecast. Know your forecast is almost for sure going to be wrong, but having the muscles to be able to adjust to however your forecast is wrong, whether you're low or high. So that's.
Love this point. Your forecast is going to be wrong. All models are wrong. Some models are useful. They are useful if they help you to identify where you are wrong really quickly so that you can course correct, because great forecasting is an exercise in execution more than it is in modeling.
Kind of the business we're in. Adult drinkware is very trend-based. We could catch fire in January and do 50% more than I think we're going to do, or we could do less. Somebody else could catch fire. Like it's very trend and social media driven. And then the kids business, I think, is very steady and doing great. I actually could probably throw coffee in there. Kids and coffee have both been pretty consistent and pretty stable. And then adult hydration has been year to year almost impossible to guess what it's going to do.
Let me just say one more thing on forecasting. I think the right approach is to forecast numbers. And by the way, we haven't done it right yet, but I think we're going to now. The forecast numbers that you just feel really, really good that you're going to hit, right?
So this language, okay, I'm gonna substitute. What he's saying, I believe, is sort of generally about a question of a forecast exists on a spectrum of likelihood of occurrence. Okay, so it's a probabilistic exercise. It's an attempt to generate scenarios or a distribution of possible outcomes. And so if you think about that, if you have a 90th percentile forecast, what that says is that in the likelihood of exceeding that is very small, 10% likelihood that you overachieve against that 90th percentile outcome, right? So if you want to be sure that you achieve the forecast, okay, you want to have a greater chance of achieving it than failing it, then that forecast would need to be below the 50th percentile, because then more often than not, you would exceed it, right? That's the general idea of a probabilistic distribution. If a game has a 55% chance of success, then more often than not, you will win at that game given the set of current inputs. Now, what's really hard, and where I would push on this idea for Jason and why this is so challenging for most brands, is because for most of them, the 50th percentile outcome is not growth. It's actually going backwards, especially in this moment. And so what ends up occurring is that there's this pressure to move the expectation up the probability distribution in order to get to a place that's acceptable, because turning in a 40th or 35th percentile likelihood of occurrence would not be growth. It would be non-acceptable to the shareholders. And so this is that tension between the idea that's being suggested, which is if you get the chance to underpromise and overdeliver, by all means do it, in so much that the underpromise is acceptable by whoever gets to decide. And that really comes down to whoever is the authority, the judge, the decider, the CEO, the board, whoever, understanding that distribution curve and understanding why the suggestion that you're making is what it is and what is true of the underlying data in order to make the best possible decision.
Like you feel really, really good.
Yeah.
And then give yourself the opportunity to outperform. I think if you look at that philosophically, as opposed to forecasting everything as like hopeful stretch, because we've done that before. A large part of it is just.
Let me give you an example of this. Okay, so in our planning section, one of the things that we do, so you can see we use this principle, board, budget, bonus, thinking about board as the most conservative distribution, budget as the 50th percentile, and then bonus closer to that 75th percentile distribution. But one of the ways that this can actually come to life is you have to have these models that help you build this distribution of probability, right? In order to think about how to change the lever. So this is what we would call a spend and AMER model. So this shows the relationship between, let's just take all this out for a second. All of your historical relationship between spend and efficiency for a business with a consideration for seasonality. You can then model a curve of that. And then you can adjust the default view of this model. So if the 0% model is this line here, this is for the month of November, the 50th percentile probability, think of it like that. Well, if I wanted to go to Jason's point and be more conservative, well, then I could reduce the expectation of the model, and that would lead to a different level of efficiency. So you can see spending $2.573 million at a 1.7 AMER is 20% below the model, whereas right at the model, you're spending that same amount of money at a 203. So having tools like this actually allow you to put into practice the ideas that he's describing around what does it mean to understand. The starting point needs to be, though, what is the underlying truth of the data? What is the 50th percentile likelihood of occurrence? And then how do I make adjustments up or down? And if I make that adjustment down, what does that do to my overall expectation of the business? What I like to say about the board number that you want, or the bonus or the bank number you want, it's the lowest acceptable number. How do you find, and where does that lowest acceptable number sit on the distribution curve of probabilistic outcomes?
Because of the levels of growth, it becomes literally impossible. But we're sort of more of a steady grower now, which is actually really nice. And so we're able to, so the philosophy is let's forecast something that we feel really, really good about hitting. And it's actually hard to do because like we all have aspirations of growth, right? We all want to hit these targets. And it takes a tremendous amount of discipline to just be like, nope, we are going to forecast something that we feel really, really good about. And then we're going to layer in additional scenarios where like we can outperform. Because actually what happened to us in 2022, we had no idea like that we were going to go 100% 2022. We grew, I don't know, I think we grew 50% in 21. And we had just no idea. So we just totally beat. All the things happened. They went well. We did a lot of things right. I think that's where you want to be. You want to just forecast where you just like, we absolutely can do this. This is like this is not sandbagging, but it's conservative. And then give yourself a chance to really outperform.
You're making a great point, Jason, because I think that the question you have to answer when you build any forecast, it's been said that more lies have been told in Excel than all the fiction books combined. And when you build a projection, it's going to be wrong materially in some ways. And so you need to understand, like, why are you building that projection? What is it helping you to do? And I think the wisdom you were sharing there is really good wisdom, because what you really can't afford to do is get yourself into a bad spot where you have to hit a number, where your balance sheet, your debt, your inventory position really backs you into a corner where if you don't hit that number, bad things could happen. And that's how we've heard, friends of ours, good businesses get distressed. And so I think using a projection and saying, I'm going to build this, I know it's going to be wrong, but I'm going to use it to get an idea of what a reasonable growth target is, where I'm not backed into a corner if I don't hit it. I think that's where we've shook out as well, organization.
Yeah, I think the forecast exists to serve a bunch of different purposes in your organization, right? So again, the reason I call it board, budget, bonus is because what Mike's describing is what I would say is the forecast that sits at the budget level. This is the CFO and cash flow management, where when you get in trouble is when your cash flow projections depend on these 75th and 80th percentile demand creation outcomes. And so as I think about that spectrum, things that are actually the decisions that could kill you, inventory purchasing, large commitments of CapEx if you were going to go build a warehouse or something, anything where you have long-term committed costs that you don't realize the value on immediately, those are the places where you can die. And those are the ones that need to exist on that probability curve that are more likely than not to happen. And in fact, those are like the things you have to be most clear on. Now, usually what that means is that you're going to leave some upside of revenue on the table. And I think unless you have an incredibly healthy cash position or a product that can sit in warehouse and never go bad for a really long time, it's usually better to exist on that. But that's only one part of it. I do think that is a distinct forecasting exercise, and these guys are all mostly speaking as CEOs, that there's a version of the forecast that is about driving your team to try to create the upper bound outcome where possible. And that if you don't give them something to stretch for, you will not get the net new ideation that's necessary to drive growth in the business. So there's this tension between forecasting as an exercise in cash flow management, forecasting as an exercise in managing a bank or a board, and forecasting as an exercise to drive your team to solve novel problems and figure out solutions. And so you don't want that to be a 99th percentile outcome for your team, but I do think that, and there's probably an interesting discussion here about what percentage of the time should your people achieve their bonus. What's a healthy organization? I don't think it's 100%. That would be the wrong goal. I don't think it's 0%. That would be discouraging. I think somewhere in the 75% of the time would be a really good result. I mean, like something like 25 to 50% of the time is actually what I mean in terms of their bonus, where it's a thing that they have to really work for. It's not a guarantee. It's not an included part of their compensation. It's a thing to go out and achieve in so much that we overcome expectation. We reach those upper bounds of probabilities. And so I think you have to think about these things as serving different purposes.
Of how we use our forecasts.
I just want to say that the smaller your business is, I don't think you have to fit uniformly into a 12-month or yearly forecast. It's like, what Mike's saying is,
I completely agree with that.
Yeah, why are you doing a forecast? And the honest answer should be for inventory planning. It's like everything else is just because you want to, have a number to show your team or like a goal to rally around. Those things are noble and good. But like the real brass tacks is you're doing your financial forecast so you can buy the inventory to hit that. And if you're a smaller brand,
there you go. That's for most CEOs what the exercise is. Actually, the forecast is just it's a tool to make a decision about inventory purchasing. That's very distinct from how a marketing team might think about it or other things. So this is just where each of these, what does the forecast for a board serve to do? What does a budget and the CFO and the inventory and demand planning serve to do? And then what is the bonus or the company goal that we stretch ourselves and push ourselves for in order to accomplish that?
And you don't want, and because it's very hard, right? I had to do November and December forecast for next year before November, December of this year happened. So it's like, what if this year sucked? What if this year was awesome? And then I'm actually projecting that will be smaller next year. However long your inventory buying cycle is, that could be your financial forecast. If you have a 6-month turn on inventory, just do that as your forecast. Because this is what we're going to do the next 6 months. And if you want to show investors or the bank a different number, I guess make it up on the fly. But you should only commit to the minimum number that you have to.
Yeah, I mean, your forecast always gets worse. It always gets worse the further out you go, I think is the principle you're saying, Sean. And so it doesn't matter how smart you are. And especially, I think with as we said, if you had to make a 12-month forecast in January, could you have foreseen everything that happened this year? No, that would be impossible. And so the further out you have to go, the more disruption and the more events that you couldn't possibly know about are going to happen between here and there.
Dude, okay, I was just going through my old notes because I have notes from every year, right? And in 2021, I'm like, look, by 2025, we'll be doing $500 million a year. I'm like, we'll be doing $500 million every single year in revenue. I'll tell you, we're not doing that this year. So,
yeah, this is just, again, when whatever moment you're in, it's really hard to believe or see that it would be different than the present. So when things are going awesome, it's really hard to believe that it could ever be different. When things are going bad, it feels the same way. So anybody in the middle of 2021, and this is like the general exuberance, this is not like some sort of like failure of Sean's. This is like a very normal principle. Go look at all of the dollars that flew into our industry, all the capital that just was poured into the businesses under a very similar idea or thesis.
2021 me totally got off. I had no idea what the future was going to behold. I was coming off of a COVID high being like, hey, if these growth rates continue, I guess I'll be the biggest company in America. And that didn't happen. Matt, you were going to say something?
I think having a good scenario planning muscle is a really good skill to develop for a company.
It so is. The other thing I'll say about planning, besides just using it as a functioning core operating system, is that the only way to begin to understand the levers of your business with more clarity and specificity is to create an expectation of what's going to happen, and then to ask yourself why it did or didn't, and to learn and to sort of bank that knowledge of, ooh, this action I took actually drove greater than expected results, or this action that I took was worse than I thought. But without the expectation to compare it against, you don't actually know if the thing was better or worse than it should have been or than you anticipated it to be. And so you don't build a repertoire of actions that are better or worse than others. And that's really the magic. Like when we talk about our event effect model, right? So I'm going to go back into Statlas here and show you this, is that there is a relationship between all these actions that you have taken in the history of your business, right? So here's like a bunch of examples of different kinds of actions that a business can take. And what we do is we tag them and we catalog the impact. And we can, if there's, let's say there's 25 product launches for this business, and then we can look at sort of a low bound outcome, an upper bound outcome, a median level outcome, and then the recommended improvement, and then the impact on specific metrics like AMER. And so you can begin to understand which actions generate which outcomes. And now when you go to build a plan in the future, you're actually pulling from a set of resources that are data-driven effects on your business. And you can say, okay, when Cyber Monday comes around, when shipping cutoff day comes around, when Black Friday, when a promotion, when a product launch, when an influencer post, whatever it might be, comes around, what effect does it create? And that process of forecasting and planning, what it does is you're forced to write down a bunch of actions that you're going to take. You're supposed to define the anticipated effect, and then you're forced to reflect on, was I right or wrong, and why not? And if you do that enough times, you will get to a very, very detailed understanding of what makes your business work.
So like what Jason and Mike are saying, I think is right. Having a baseline budget that you're like, I feel really good. I think we can definitely hit this. That's one. And then just knowing your scenarios, like upside or downside, and like what happens, and then what parts of the company needs to change if you do start to outperform. So what Jason's talking about, we didn't know that we were going to double. It's like, imagine the stress that puts on a business to try to keep up to that pace now, just inventory and cash cycles. Like it's very difficult on both ends of a miss. So I think knowing your scenarios up and down is good advice. And I think the other thing that Jason's hitting on, and what I wanted to get at when it comes to like having a budget that's like you can hit it, that's really important for your team. Like nobody on a team likes to feel like they're losing. So if you said we're going to grow 100% and then you grow 75%, your team's going to feel terrible and you'll feel bad. But if you said you were going to grow 50 and you grew 75, you're going to feel like a freaking rock star.
Yeah.
So like expectations are super important for how you feel about your company.
Yeah. Or you say you're going to grow 100%, you grow 75, and you're like, well, that's still pretty good. Then they're going to learn that they can miss their numbers. They're like,
Right.
Yeah.
Right.
We missed about 25%. It's still good.
Yeah, this is such a dance. This has been one of the hardest challenges, I think, as a leader throughout my career, is trying to figure out the right level to push. How hard do you push? One of the things I think you have to find is intrinsically motivated people that can actually disassociate themselves from whether or not they achieve the outcome as specifically defined, and go again and go again and go again. So you don't run into this cycle where if you don't guess exactly right, if you don't set the marker exactly appropriate, they feel too discouraged or too overconfident, but that their behavior is actually about their character and about the fact that every day they go out and compete their butt off to be the best possible that they can. That is an intrinsic attribute versus like you trying to figure out how to perfectly set the goal to get them to behave a specific way is almost impossible. And you'll just get it wrong too often. So it's a challenging idea that I think sometimes our translation of the issue, which is that we think, oh, we just got to set the goal better. What I've found is that there are the kinds of people that whether they achieve their goal or not, their behavior is always the same because it's an intrinsic desire to be awesome that they want. And now they do want to win games and they want to understand the rules, and you should work hard at it. I'm not saying that you should absolve yourself of the responsibility of setting good goals. But this idea that they become perpetually discouraged or something, I think is often not true for the highest level performers I've seen.
We did an exercise that was really helpful where we looked at, okay, out of every, $100 in revenue that comes in, what percentage goes to different things, and kind of dreamed up like, well, what is the ideal P&L for our business? How do these percentages work? And this is one of the reasons why I think in general, having projections and goals that if anything, undershoot what you're capable of instead of overshoot. It's really easy once you've done this exercise to understand why that's so important. Because if you are undershooting on your demand that's available to you, for example, Jason's 2022 example, you can always pull back on marketing. You can always goose margins. You can always hire more people. And I don't think that the demand evaporates or your business is distressed in any way. But the opposite side of that is devastating. If you think that personnel, for example, is going to be 10% of every $100 that comes in, but you miss your sales targets by 33%, and now personnel is 14% or 15%. These are the type of things that can just wreck your P&L, and you get out of proportion, I guess is the way that I would say it. And when you get out of proportion by being overly aggressive, all of the consequences of that are far, far worse than getting out of proportion by underestimating your demand. Those are good problems to have. Those are solvable problems. And if anything, your margins just blow out for a period of time while you catch up. Whereas if you get the opposite situation, like you get super distressed. And so
yeah,
one of the guys on my team, he made a really good observation.
This is always true. It is almost always better to sell it. This is why there was this whole argument on Twitter a while ago that selling out was bad. And this is just nonsense, right? You get to capture excess margin when you have demand in excess of supply. Like this is just very simple. If you have too much demand for your available supply, you will maximize the margin capture on that inventory versus the alternative, which is if you have excess supply versus demand, you will have to decrease the price in order to move that inventory. And so, yes, you want to go again. And I get this sort of dream of perfect equilibrium between demand and supply, but that's like, it doesn't exist. And so you're going to exist on one side of that line all the time.
Because we set some goals this year that were overly ambitious. And he said to me last week, I think I just got a little bit greedy for growth. And I didn't realize that if we just grow this business at 10 to 12% for the next 10 years, it's $1 billion revenue company. And so it doesn't have to happen all at once. 10 or 12% is very achievable. But when you put up goals at our scale of 20, 25, 30%, I mean, you said it, Jason, it just gets harder. The growth gets harder the bigger you get. And you have to develop kind of a respect for that.
Law of large numbers, man. Like when you got to put up like 20% on hundreds of millions of dollars. It's like you need to go find 30, 40, $50 million.
Yeah, or another way of saying it, Matt, is it took us maybe 3 or 4 years to get to 40 million in revenue. But when you're at 200 million in revenue, growing 20% means basically adding on the entirety of our company that took us 4 years to build, right? It's not so simple, and really the thing that we've learned is we've got a lot of really healthy parts of the business, and then we've got these other parts of the business that have been boom or bust. But when you want to grow at 20% and you have several different aspects of your business, it's very difficult. None of your parts of your business can really take any kind of a step back and you still hit that number, right?
Okay, I have a question that I just want to know, because you said 20% a couple of times. I'd love to hear what you guys think is a good growth rate.
20 to 30% compounded over time is insane.
So that's insane. So Mike, what do you think, like a business in your size, not necessarily your business, right? But like a business in your size, like what do you think is a good growth rate? Like that you'd be like, this is great, or I'm proud of this.
Yeah, I mean, I think in my mind, Jason, it's drifted downward over the last year or two because I've come to respect how hard the growth becomes as you get bigger. And so I think most public companies are trying to grow profits, 10 to 15%, and they're, $1 billion plus. And so in the range we're in, I think more, 15 to 30% is probably a window. And if you're at the higher range, I mean, we had a year in 23 where we grew about 100%. We added almost 100 million in revenue in a year. And so it feels easy when you have a year like that. And then I think 24 and 25 have just reminded.
Okay, this is a really important topic. I think that this is one of the things that I would contend that the mistake that all of these businesses made, all of them made, was the 100% growth year. Is that the problem with our sector of consumer products is that if we think about the value generally as being a willingness for investment capital to flow in as an assignment of value and opportunity to our industry, that's where like the multiples come from, the valuation comes from, is that somebody has to look at the future of the business and believe that the deployment of capital into this vehicle is going to generate a return better than all the relative options in the world. This is really important, is that like we aren't just competing against each other for the ultimate investment dollar, right? And so if we look at let's go back to our friend ChatGPT and say, how much has Meta grown profits over the last decade? And when you think about an option where we say, okay, if the net income of Meta compounded at 17% per year for 10 years, that implies roughly a 4.8 multiple, The same source lists that revenue growth at about 14.2% that year, growth of net income of 17.2% for a decade. Okay, and this is a business that's worth hundreds of billions of dollars, right? So if you have a market environment where there's an option for people to go deploy their capital into a business like Meta that's compounding net income at 17.2% every year for a decade, okay, and you come in with a hard goods, durable business with minimal moat to the market, high levels of competition, and you say we're growing 15% a year, it's just a fundamentally worse investment thesis for any dollars to flow into that business. And so what has to actually be true, I think, in these consumer businesses is that you have to show a path to growth at like 30 to 40% for a very long time in order to warrant a deep value. Now, or you have to have such confidence in the predictability of the 15%. So it has to be more predictable than Meta at 17.2% for a decade. It has to be more certain than that, or it has to be better than that. Like at the root level, that's the value dilemma of our industry. And hard goods in particular, where there is almost no LTV, the future revenue quality, and Sean's going to go into this in a second, and this is why I have so much respect for these businesses, all of their businesses. Actually, I don't know enough about Lomi. I think they have a recurring software model, but all of them have virtually no LTV. And so they've had to be these acquisition machines. But I would argue that every one of these guys made a mistake in the period where they grew too fast, because they created then a future comp where they are never going to be able to replicate that. And so what you're going to get is 100% growth into 30% growth, into 15% growth, into 8% growth, into 10% growth. And the problem when someone comes to deploy their money against that, if they're doing a DCF, a discounted future cash flows, the growth rate of that money relative to the other market options, and when we're talking about big dollars, we're talking about hundreds of millions of dollars, those are the alternative investment options. Now, there's plenty of funds that have an investment thesis that's focused into our industry, but the LPs and everybody else, when they look at the options, it just doesn't make sense at some point. And so if you can hold instead 30 to 40% growth for a long period of time, I think you end up with something that is healthier and better and actually provides the investment return on the amount of dollars necessary. Now, there's all sorts of caveats here about the capacity to use debt leverage that adds a dynamic to the return profile that certainly makes sense and things like that. So it's not, there are certainly, there's nuance to the discussion. But in many ways, I think this is the fundamental problem facing our industry, is that the revenue quality of hard goods, where there's no obvious LTV or compounding of the business, makes it such that the future forecast growth, to Mike's point here, where he's saying if you could take a step back in any category, if water bottles become less popular, then all of a sudden, like the how hard it is to grow is actually like monumental. It's almost like you've got sort of two forces acting in opposite directions. You've got gravity pulling down some category that's getting commoditized and competed away and sort of moves through trend between different competitors. And you have to now go overcome that to go generate future growth on top of it. And so as someone who would look to deploy money into that, it's like, why is that a better option for me than everything else that exists in the market?
Man, that is so abnormal, so atypical that really, if you're in the 20s or low 30s, then man, you are crushing it at this size. That'd probably be my take today.
If you don't have a network effect or compounding nature to your business, if you're hitting 33% growth, you are, that is top decile. It is creme de la creme doing that. And Taylor Holiday has a chart, and hopefully we can find it and share it.
Okay, so here I am, Taylor Holiday. I'm going to show my chart as Sean is saying this. All right, here it is. Continue on, Sean. I'll show this as we're talking about it.
But it's from like 2024. It went super viral, and it was about he called it the Mona Lisa of e-commerce. And it was a business that started out with a lot of new customers, and then over time, the returning customer rate, just every day, 80% of the transactions were returning customers, 20% were new customers. That is some sort of network effect compounding on itself, right? That is, I'm sure, the same chart that Grun's has.
Yeah, this is it. This is the kind of business that compounds future value, right? Because think about in most e-commerce businesses, the game is you run your new customer acquisition at basically contribution neutral, or even if you can be forced short or profitable a little bit, that's awesome. But nobody is like I shouldn't say nobody. Very few people are like 30% contribution profit on first order, such that when they get a bunch of new customers, they grow contribution dollars. Usually, new customer revenue is contribution neutral, or in many cases, contribution margin negative. And so all of the value of the business, all the margin profile comes from returning customer revenue as a percentage of total revenue. And so what this graph is orange line is returning customer revenue, blue line is new customer revenue, where basically you hold new customer revenue constant or experience small amounts of growth over time. Returning customers compound, so you're stacking all these cohorts over time, and MER, or marketing as a percentage of revenue, goes down and down and down, margin widens while revenue grows. That's where that's what a network compounding effect would create. It would create margin expansion over time, even as the efficiency of acquisition degrades. Now, this business, the other thing that's really important is that one of the reasons brands can't often pull this off is because even at the same volume of new customer acquisition, the efficiency degrades too much because there's basically no competition. And so the next customer costs more to acquire at the same volume that it did the previous year. And so you get this degradation of new customer acquisition that offsets the growth of LTV. And that is like one of the fundamental constraints too, is that you have to have some defensibility to next year's new customer acquisition. I've talked a lot about this with Ridge. I think it's one of the reasons that their IP defense was actually so important to their success. This business, I know, has actually a supply chain moat that actually allows them to minimize the amount of competition that floods into their space. I don't know that Grun's does. I don't know that some of these supplement companies actually do. And so there's this like, one of the things that tends to be like praised is, oh, supplement companies are so awesome because of their LTV, but it needs to also be paired with defensibility of acquisition in the future. So lots here, but this is the dream state, because in this business, revenue grows and margin expands over time, where in most businesses, as revenue growth happens, it costs more and more and more. And so margin degrades as you go out and try and accomplish it.
Grins goes out there in the ad auction. Every day they had 1,000.
And this is even more true when you try and grow too fast. There's this velocity constraint, is this principle that I talk about, which is that your business natural growth rate is what you compound LTV in a year. So if you compound LTV in a year 30%, then if you hold new customer acquisition constant, you'll eventually get to a growth rate that is about 30%. So the rate at which you're able to grow, and when you offset that, this is why when I look at Jason or Mike or even Ridge, is that when they grow 50, 100%, what they actually do is that they've just borrowed from the future, because they basically, what they've done is they've taken a period where the efficiency of new customer acquisition was so good, but the problem is next year it will never be that good again. It'll get worse. And so you trend backwards at some point when you take those spiky moments. And it's really hard, because when things are really good, it's really hard to say, no, we're just going to have this discipline to hold. And you also might be ceding market share. It might not actually be an option. You might lose in that game, but that's the challenge with this business.
New customers, but the next month, 800 of those people come back. The month after that, 750 come back, right? And so every day they have this compounding nature. Ridge has the exact opposite chart. Me and Connor were talking that we have the doomer version of the Taylor Holiday chart. If I showed you my new customer rate over time, I've added like 1 million new customers this year.
This is why, there's this thing right now that it's like a really weird thing in our industry, which is that and it's because there's some loud voices on X that have sort of like perpetuated the idea that the best version of media buying is like you get to spend $100,000 a day at a 0.3. And I just go, that is, there's nothing that illustrates excellence in acquisition by doing that. Excellence in acquisition is what Ridge has to do, which is they have to go out and actually win at 1/8 to 2-to-1 at massive scale for the survival of their business every month for a decade. It is so much more impressive to me to produce scale at first order profitability than it is to say we have incredible LTV, which is really about it's not about excellence in acquisition. It's about excellence in retention and product design. It's that you have subscription functionally is what it is. But excellence in acquisition, go study Ridge, go study HexCloud, these businesses where it's like they have been able to drive new customer acquisition at first order profitability at massive scale. That is what actual excellence is in execution and media buying.
Year. That means they've never heard of Ridge before. How did I find those people, right? That is, I made the joke that eventually I'll acquire everybody on Earth, and then my returning customer rate will be 100%. Like that is the rate that we're going at.
You're gonna have to go to other planets. We're gonna have to go interplanetary for Sean to continue to acquire. But I mean, it's such a great point that in durables, which all of us sell a durable, there's this kind of perverse thing that goes on that the better your durable is, the more problematic that is.
That's right, because there's no LTV. Like the lifetime warranty of a product literally means there's no planned obsolescence. There's no need for repurchase at all.
If we sell you a water bottle that you can use for 5 years and it's great and it's going to hold up, awesome. But how in the world do we get you to come back to buy more?
Totally.
But this is why Apple creates versions, right? It's not because you need a new iPhone next year. It's because the entire point is I have to get you to buy again.
And this is why category is the most important thing. I think all of us have flirted with the idea of something you put in your body because we want you to consume it, because we're very good at acquiring customers, but we have to figure out how to get that compounding nature. So to Jason,
you have to make last year's product irrelevant. That's the fundamental need, is that you have to make people feel like having the HexCloud Pan 1.0 or the Ridge Wallet 1.0 is not good enough anymore. It's just like the second the iPhone 20 comes out, my iPhone whatever feels obsolete. It's like you've forced me into this game where through status and other signals, I now actually feel that I have a deficiency using your previous product.
Question. I mean, I'll think of, On Running is like the best consumer breakout brand. It's very much rivaling Nike, right? I remember they were publicly at,
to be honest, I never have understood the on-running thing. I think the product is hideous. I don't get it.
75% growth 1 year, right? So like that is not even top 1%. They're the best you can possibly do at that scale. And then it just goes down from there. I mean, Yeti this year, revenue will be up 2%. So it's somewhere between 2 and 75%. And if you can consistently hit 25% growth in your business, I mean, Mike read the numbers, you get $1 billion in revenue.
25%, you double every 3 years, guys. That's so hard.
The reality is that it's very similar to investing. So if you look at investing, you look at the best investors. The thing that you see is their early career, they put up these unbelievable returns. Like Warren Buffett in his early years, it's like 100%, 150% years. And then, people realize, oh, this guy's a great investor. Plus they're growing their capital. And so more people are wanting to invest with them. And then they're hitting 50% returns. And then, they grow some more. And now they're managing a few $1 billion and they're hitting 30% returns. And then they're managing tens of billions of dollars and they're hitting 20-something percent return. And the point is that by being good at something, you earn the privilege of scale, but that is always going to pull down on the growth and the returns that are possible. And it's the same way in business. It's in some ways, the best people in business end up having growth rates that are fairly unimpressive, but because they're running really big businesses, that the game gets proportionally harder, growth gets proportionally harder, the bigger the thing that you're managing. And so it's real sexy to say, oh, my business grew 100% year over year. But in general, what you're really just saying is that you're playing at a level of scale where, the big dogs don't really compete. as your growth rate goes down because you're dealing with a bigger business, you're competing against better and better competitors because you're managing more money and because the nominal impact of that growth is bigger and bigger.
Okay, let's talk about GDP plus businesses. So Amazon.com, this is not their AWS services. This is not everything else. Just like people buying stuff on Amazon, I think it might grow 5% this year, right? Or, early in the year, I think they want to grow 10%, right? So if you're getting bigger than 10% growth on Amazon, think about that logically. The whole pie's growing 10%. I'm growing 30%. That means somebody else is shrinking.
Okay, this is not true. This is Sean doing out loud math in a way that's just not true. So let's do the math. Let's keep this simple. If Amazon.com was $1 billion and it grows 10% or 5%, okay, adds $500 million in revenue, okay, your business, okay, could grow 100% of that from $1 million to $2 million and not have to take share from anybody. So first what happens is there's $500 million of additional revenue that gets assigned out across everybody in that growth profile, right? So there are lots of businesses that could be growing hundreds of percents or tens of percents or 50% and not have to be taking share from anybody when there's GDP growth. That's not true. So it would be true if there was no growth. If the GDP of Amazon grew none, then it would have to be a zero-sum game. But when there's overall net growth, small businesses or even pretty big ones, if you were $20 million in revenue, you could double and not necessarily have to take market share from anybody. Now, generally speaking, the principle that he's getting after, which is that if everybody was going to grow 20% or half of people grew 20%, then yes, that would be true. But what often happens is that there's these individual pockets of category growth where there'll be like gummies as a category. Everybody in that category will experience growth, and powders will experience some small decrease or won't grow at all. And so you'll have this category growth of $100 million of the $500 million total pie where everybody in that category grew a lot, and other things were neutral. Now, do some things get smaller? Yes. But it is not, when there's GDP growth at all, there's positive sum growth, it doesn't have to always be a zero-sum game. A zero-sum game is literally like, it's counter to the idea that there is growth. There was overall industry growth, and so it's not a zero-sum game. It doesn't have to be like that.
Right? Because
it's zero sum to some extent, right?
Yeah. We talk about e-commerce is infinite. We can go out there and generate demand. But inside of a marketplace in particular, if they're only going to grow 10% and you're going to double, someone else has to shrink for you to get those sales, right? And it doesn't have to be in your category. It's not directly your competitor or whatever else, but Amazon does need to shrink someplace else because their whole pie is only inflating 10%. So you should also just understand like the world you operate in, right? If Amazon's only growing this much, if Target's going to be down year over year and you're up in Target, somebody's losing shelf space. You know what I mean?
So that's
just
different.
And the bigger you get, Sean, the more that share that you're taking is going to be coming from somebody with a big freaking company and a lot of resources, right? You nailed it. It's okay. If Yeti is going to grow at 2% and I want to grow at 10%, then it kind of stands to reason that part of that has to be like, I'm pulling people away from Yeti, who's a multi-billion-dollar company with tons of resources, right? And that's not super.
But that Mike benefited. There was a period where when Stanley exploded, everybody grew because the whole category grew a ton. So it's not this directly zero sum as we're describing.
Easy.
Yeah, and on .com, I think you control your own destiny, where like you're actually not directly stealing. Like you can go out there and get people into your business and into everything else, but specifically with the channels, right? I think about if you want to be a fast-growing candy company in Target, and Target's going to tell you the candy aisle is going to grow 3% this year because 3% more people are going to walk through it. You're going to grow 100%. Snickers is selling less.
Again, it's not. Their category is so big that like your business is small. If candy's $100 million and you're currently 100,000 of it, you could 10x your revenue and still not represent that needing to mean that anybody doesn't grow, because maybe all of that 3% growth is you and everybody else is neutral. So again, this is bad math here, guys. This is not true in a category where there's actually growth.
It's like there's no other way to get to that number.
This is also how you get bought, by the way, by the big public companies, is that you do come in and successfully compete and still share. And then they say, if we acquire this thing, it can provide the inorganic growth that we need to hit our numbers. If you look at public companies do acquisitions because they cannot get organic growth. Everybody runs out of organic growth eventually, right?
This is true. And I just had my board meeting at CTC yesterday, and we're having discussions about M&A. But the challenge with M&A right now is that we're growing well organically. And so adding inorganic growth is actually hard to make it worth money, because if we're going to use any equity of ours at all to buy their company and our company grows faster than their company, it actually becomes a bad purchase for us in the end. So you just have to be careful about thinking about this. But oftentimes M&A is a mechanism to fuel growth that doesn't exist organically. Otherwise, you have to find something that's growing faster than you.
Jason?
Yeah, IBM was that way for decades. They were just an acquisition machine. There was no organic growth, right? No one talks about IBM anymore, but that's why. Like, they weren't able to continue to innovate on their own. It just gets so hard. I think 20% growth, if you are 300 plus million in revenue, or even 200 million in revenue, if you can grow your business with a 2 in front of it, and have margins with a 2 in front of it, and you can have a path to sustaining that. Like that to me, it's hard to do a lot better than that, guys. On Running is an incredible story. I saw them speak at the ICR conference last year in Orlando, and it's incredible. They're such rarefied air. It's like this is like the edge of the curve, right? And even we at Hexclad are in many ways like at a different. We're pretty far out there on the curve too. Not anything near what On Running is, but you just see like the tail. Like the tail, it just gets it's crazy.
But can we just acknowledge then, like On Running, a lot of this is just cultural phenomena. Let's not listen. They run an incredible company. Give them all the credit they can. But like, guys, they're the most popular freaking shoe in the best customer segment, and they've been able to they're keeping it. That's culture. That is not, oh, that guy's a genius. No, like you've just nailed a
and it'll
trend.
end. It'll end. And it's coming from Nike, who 5 years ago. I mean, there was a point when we did the show early on where we said, who do you think is the strongest consumer brand? And I think Nike came up a couple times for us. And it's On Running is part of the reason why Nike has really sucked recently. And so even when you have a period of the kind of success that On Running is having, I guarantee you in the next 5 years, there'll be a period where the worm turns and there's negative growth, or the growth is they totally stall out, because that's the nature of business, that it never goes on forever. It always, there are these ebbs and flows that come to things.
Okay, it's the nature of the consumer business, right?
Totally.
Because
Yes, that's a great distinction.
Okay, this is important. And Sean, I appreciate he's always honest to call this out. This is not true in some of these software businesses or other things where these dynamics don't exist. And it's why it's a struggle for us to compete for the dollars when trend does affect the business model so dramatically.
Distinction, Sean. It's a nature, like there are some businesses, Molson Hart posted a chart of UPS and FedEx price increases over the last 15 years. And it was literally just the same number every year for 15 years. It was we're just going to raise prices 5.9% every.
So real quick check. So On Running is roughly grown a CAGR of about 105% of net income over that period from 22 to 24 when they flipped profitability. And again, this is where this is actually the window in which you want to be being evaluated by the market. And so for so many of these guys, and I've seen this for so many of the 9-figure e-commerce brands, is that it's funny. I had a conversation with Cody at Jones Brothers where I told him he needed to sell his business. Like, you want to sell, you want to be being valued in this moment here, right? Because the comps on this in the future are about to get really, really challenging. And so just getting to this is the standard, actually. It's not this 20 to 30%, because otherwise you're just going to compete with an alternative of, well, Meta's at 17.2% for a decade with this massive revenue base and this incredible business that's functionally a monopoly, or I could invest in your hard goods business growing 50, 30, 18%. Like, why would capital logically choose that? And so I think this is really important, is that this is actually what you need to do to go out and capture a ton of value by the market. The bar is just so freaking high.
Single year. And that's not a consumer business, really that's more of a B2B service business. When you're selling consumer products, trend is a huge part of it. Like you're saying, Matt, and you cannot stay on trend forever. That's an impossibility.
yeah, dude, nobody
Yes.
cares if the oil comes from Saudi Aramco. You know what I mean?
Right.
80 years of the empire pumping out oil, right? But you know what people really care about? The shoes on their feet, right? And Nike did fumble a bag, and On Running was there to pick it up. And we wish them all the best. I hope they become the next Nike and go out there and crush it. But statistically, in consumer, you're lucky to get cool for 2 years in a row. You know what I mean? And
See, for example, Lululemon. Example, Lululemon. 2 years ago, I was like, Lululemon, this is the benchmark for me in running a business. Yeah, I know, but I'm just talking about me, right? Like I was like, this is when people are asking me, what are our comps? Because it's very hard to comp our business, very hard to comp any business, but really hard to comp our business. I was like, okay, well, let's look for really great consumer brands. Best in class consumer brands are the comp, right? And now you go to Century City, Westfield Mall, and it's there's a sick Alo store, there's a sick Vuori store, there's Beyond Yoga, and it's Lululemon got outcompeted, whatever it is. They got outcompeted. And as Mike said, a big part of that is it's just trend. What is on trend? And good businesses like Lululemon and like ours, you really have to be thinking about what are the upstarts doing? Who wants to come and eat your lunch and continue to innovate? If Lululemon dropped the ball, I think Nike has dropped the ball, and On Running is an incredible story. And if you look at Alo and Vuori, their stores are sick. And I'm at Neiman Marcus buying a coffee, and the girl on the line in front of me is wearing Vuori. She's not wearing Lululemon anymore.
There's two different types of growth, and I think it's important to delineate. There's kind of structural growth where it's we built stores, we added distribution, we made forays into product categories where we've established a beachhead, and that is durable growth. And then there's, I'll just call it sexy growth, which is you're the flavor of the month. And if you run a brand and you experience some of the sexy growth, and we have at points, and we've had other competitors that have experienced a ton of it. Stanley right now, Owala's kind of getting the sexy growth. When you're planning your business, I think you really have to count that sexy growth as eventually it's going to zero.
Well, especially when none of the customers that you acquire that during that time come back because your LTV is nothing. Now, that sexy growth can compound in really powerful ways if you have LTV base off of them. But yeah, if it's a one-time acquisition, all it's doing is ensuring that your growth rate in the future is smaller.
That's not sustainable growth. That's not something that you can feel like is actually yours in a way that you can hang on to, because you know that those people will go other places. And then I think the other point to what you're saying, Jason, which is really worth mentioning, is that when you do put up exceptional result, other entrepreneurs see that, and there's going to be a flood of competitors that are trying to do the same thing. There's a whole generation of entrepreneurs that are looking at On Running and are like, I want to launch a shoe brand, and they're going to come for them. And some of them are going to find a way to knock the king off the hill. And that's the nature of capitalism and entrepreneurship. And it's beautiful, but like, you can't have just unbelievable, industry leading results and not expect for just a throng of really talented people to come and try and take that from you.
Mike, I was going to make the same point. Great fishermen don't tell you where they fish, right?
Absolutely.
And we've seen Lululemon they were worth more than Nintendo or Honda. They were a $40 billion company. And eventually, millions of people tried to outcompete them. Eventually someone will, right? And it's the same thing with Nike. They were the most valuable single consumer brand, right? They were worth $150 billion. And everyone makes shoes. Eventually someone's going to make a shoe that's better or cooler, or something's going to click. And that's kind of what happened. So yeah, I think that's sexy growth. And you brought up Stanley. They're like the poster child of this like inorganic growth dying eventually, right? Like amazing, huge, great outcome. It was super, super hot. There's no way to follow that up. You know what I mean? It's like,
Sean, this dovetails into all of your, like, the management part of what we wanted to talk about today in the pod, because really what it is about your organization being able to stay sharp and stay competitive. And it just gets harder too. Like when organizations get so big, there's so many constituents, there's so many people. It's like On Running was just way scrappier, way scrappier. Alo was just way scrappier. Viore was way scrappier. And you lose your scrappiness and it just becomes really hard. You have to, like, as a leader, I
think a lot of those businesses, though, Alo and Viore in particular, they are examples where they benefited from the massive run-up of acquisition demand in the COVID era, but with a business model that compounded the value of those customers. And so if I contrast, let's use like Solo Stove as an example versus a Viore as an example. The distinction is they both blew up to hundreds of millions of dollars in revenue during that period. But one of those business models, they compound the value of those customers after you acquire them, and one of them they don't. So for Viore, all of that new customer acquisition in that period turned into this base of customers to sell to in all these different ways that they've been able to continually monetize. Whereas Solo Stove, it just disappeared. You could look at Ruggable, versus Alo Yoga in a very similar fashion. Skims versus the other things, is that there were some legendary businesses built in that era where the acquisition arbitrage got so big. And this is actually, I think, part of why those brands like Lululemon actually struggled with COVID. And I got a chance to work inside of one of them during that period, is that they didn't have a new customer acquisition muscle. It wasn't part of the DNA of what they looked at and thought about, is that they didn't even draw distinctions into things like AMER or all these metrics that all the upstart businesses cared a lot about. And so they had these customer files that were shrinking. They were selling to the same people over and over again. And the businesses could work. And in COVID, they actually just went and squeezed and extract all the value out of them. So I think that is one big distinction, and why some of those businesses were able to get so big during that time, and why they've been able to continue it while others have just completely flopped.
really believe this. How do you keep the scrappiness and keep the culture? And it just gets harder and harder and harder the more bodies you add.
Hopefully you enjoyed this, interact with this. I like doing this sort of a stream of thought. I enjoy listening to the content in these various ways. So if you enjoy listening with me, let me know. Leave a comment here, and we'll chat soon. Peace.